get to some of that selling action that Jared was just talking about. When you take a look at stocks and also bonds plunging this morning following the CPI report that came in hotter than expected. Our next guest warning that President Trump's protectionist policies could trigger even more inflation and bring interest rates higher. Joining us now, we want to bring in Mark Zandi. He's Moody's Analytics chief economist. Mark, it's great to have you. So clearly the market is worried by the print that we saw this morning. How bad is it in your view?
Not good, Seana. I was surprised. Caveat, this is the month of January. Lots of businesses raised prices during this month. This BLS, the Bureau of Labor Statistics, the keeper of the data, tries to seasonally adjust to account for that dynamic, but it's difficult to do. So this may overstate the case, but, I think there is a case here that disinflation we've been enjoying, the slowing in the rate of growth of inflation that we've been enjoying since the summer of 2022 may now be coming to an end. The thing that surprised me the most was just the broad-based nature of the price increases. It wasn't just, grocery prices related to eggs and avian flu and gasoline. It was prescription drugs. It was motor vehicle prices. It was motor vehicle insurance. It was, airline tickets. It was lots of different stuff. So, because it was so broad-based, it makes me feel like not that inflation is picking up yet, that's something to worry about with regard to tariffs, but that the disinflation that we had been enjoying is now over. And unfortunately, we're not quite back to the Federal Reserve's target. So that's disconcerting.
And so now this is pushing back even further some of the strongest possibilities for a rate cut. How do you think the Fed is going to be looking through a report like this and reports thereafter? Because we know they look more for a trend rather than just kind of basing the commentary and their discussion on one report.
Yeah, for sure. They'll wait and see. I think they're on hold, not only because of the data like we got today on inflation, but the economy is strong. Job growth is very healthy. It's up a little bit, 1 month down a little bit, but, cutting through the volatility, it's very good. Unemployment's low. But the thing I think, seals the deal here on no change is policy, economic policy, tariffs, immigration, fiscal policy, tax spending. It's all up in the air. Hard to know how that's going to play out. And, things like tariffs and deportation, it's really complicating for the Fed, because both those things add to inflation. So that suggests higher rates, but it also weakens growth, which suggests lower rates. They're kind of in between and betwixt. You don't know what to do. And I think given that, they're just going to sit on their hands here for a while. I certainly don't see any rate cutting or change in the first half of 2025.
What about the second half, though, Mark?
Possible. I think by then, Seana, you will get more clarity on these policies, just by definition. We'll see how broad-based the tariffs are and, how impactful they are on inflation expectations. We'll get a better sense of immigration policy and perhaps most importantly on tax spending policy and how much deficit financing will go on. And I do think by the end of the year, the growth effects of the policies that we're talking about here will overwhelm the inflationary effects. The hit to growth will be significant and measurable and meaningful. Manufacturing, agriculture will be under a lot of pressure, assuming that the president follows through on these policies. And that will win the day, and the Fed will start cutting rates. The other thing to note is that the so-called equilibrium rate, that R star, that rate at which policy is neither supporting or restraining growth, that's going to come in here. It's been very elevated because the economy's potential rate of growth has been very strong for a bunch of reasons that are going away. And as that potential growth slows, so will the R star, that'll fall, and that'll give some room for the Fed to start cutting rates, but not until the end of the year going into 2026.
What typical lag time is there from the point where we see tariffs talked about and then implemented to the point where it actually starts to show up in economic data prints?
It could be weeks, it could be months. It depends. As we've seen the tariffs so far on again, off again, with Canada and Mexico. It also depends whether the tariffs are imposed on consumer goods, because if they are, then that'll flow through to consumer prices a lot more quickly, or investment goods. If it's if it's a tariff on machine tools or machinery or aircraft, then that takes a long time for that. It'll affect pricing in those industries and the producer price indices, but it won't show up into the consumer price indices for a while. But the biggest effect may actually be on inflation expectations. You can see from the University of Michigan survey report, and even the New York Fed to some degree, consumers are really on edge about inflation. They're very sensitive, for understandable reasons. They've been through inflation hell, and they, very sensitive to it. So if they feel like the tariffs are going to start to raise prices and it shows up in inflation expectations, that by itself could be enough to certainly have an impact on monetary policy, wage demands, and inflation itself.
Yeah, and Mark, to that point, is it enough for the Fed to then focus on the price stability part of the equation more, right? When you talk about the expectations component of it?
I think right now, and most immediately in this period of heightened uncertainty around what policy is going to be, it's mostly about inflation, particularly in the context of a report like today. Like today's report says, hey, maybe something, broader is happening here even before the tariffs hit. We got to pay attention to that. We're not back at target. And actually, we're meaningfully away from it. I mean, year over year, CPI inflation is over 3%. Something consistent with target would be closer to 2.5%, and we're moving in the wrong direction. So that by itself, I think, would be enough. But yeah, you're right. I mean, with fragile inflation expectations and tariffs dead ahead and deportations and the impact that's going on labor supply and wage demands and everything else, I think they just say, hey, we just can't move here.
How tremendously do you impact, or are we able to kind of quantify at this juncture how much even deportations also have the broader impact on the consumer demand profile, and then additionally as a pass-through to other inflationary prints?
Yeah, we can't, Brad, we can't do any of that because we have no idea exactly what's going to happen. I mean, that actually, there's a broader point. The real damage from things like tariffs and immigration policy, the way it's being implied, is the uncertainty it's creating. We have no idea how it's going to play out. But I do know this, immigration obviously put enormous pressure on many communities across the country. And, the immigration across the southern border is a national security issue, no doubt about any of that. But the one benefit of that immigration is those folks, they applied for work and they are working, and it lifted labor supply and cooled off the labor market and allowed the economy to grow a lot more quickly. That's going to go away, by under the policies that are being implemented. And that's going to tighten up labor markets, particularly in sectors of the economy where inflation is most pernicious. Food, think about all the immigrant workers, particularly undocumented, that work in the agriculture or food processing industry, on the farms. Construction, which goes to the cost of housing and goes to rent, supply of housing, rents, and the housing costs. Those are the things that really, those are necessities. I got to live somewhere. I got to buy food. And, if the immigration policy causes costs to rise in those industries and prices to rise in those industries, that's going to be, more of an issue, more of a problem for the American consumer and for the Federal Reserve Board.
Mark, one thing that we do know for sure is that you are in the area that is celebrating right now quite a bit. So hope you guys enjoy the parade.
Yes, you too, right, Brad? You're from Philly.
Yes, indeed.
Yeah.
Yes, indeed. It's been a great week.
Yeah.
Hope you enjoy the parade later this week.
Go Birds.